The Philippine stock market is still 31% below its 2018 record, even though the economy has become so much larger. So why am I still underweight? Well, cheap can mean two completely different things. It can mean investors are overlooking a real opportunity, or it can mean the market has correctly identified a problem that earnings have not yet fully reflected. In the next 12 minutes, I'll show you why Philippine growth is slowing in a very specific and important part of the economy, why inflation and the peso are making the BSP's next move much harder, what the PSEi's decade of stagnation is really pricing in, and five characteristics I would demand before buying any Philippine stock in this environment. Then I'll give you my updated grade score, growth, rates, and inflation, earnings and valuation, adverse risks, and trends in foreign flows, and what that means in practice. So the conclusion here is not to sell everything. It's more useful than that. Months ago, an executive from a major conglomerate asked me a question that captures pretty much the frustration around Philippine equities. So he asked, our earnings are up, the economy is much bigger than it's ever been. So why does our market cap still keep falling? It's actually a fair question. The PSEi remains well below its all-time closing high of 9,058.62 reached in January 2018, yet the country has added consumers, infrastructure, corporate revenue, services capacity, and nominal GDP. In other words, the economy moved forward, but the index did not keep up. But markets do not price GDP alone. They price in earnings, interest rates, inflation, currency risk, governance, liquidity, confidence, and capital flows. So the market question is not simply, is the PSEi cheap? The question is it cheap enough for the risks that remain? Let's begin with growth. Philippine real GDP growth slowed from 5.5% in the second quarter of 2025 to 2.3% in the second quarter of 2026. That's the weakest non-pandemic growth since 2021. On the surface, that looks like a broad recession story, but the composition matters much more than the headline. This is not primarily consumer recession. Household consumption still grew by 2.8% rather. Government spending grew by 8.3% and exports grew by 12%. The real damage was in investment. Gross capital formation fell 9%, industry fell 2%. That's a critical distinction for investors. When investment contracts, the most exposed areas tend to be property developers, construction names, industrial capex plays, businesses dependent on project spending, and companies carrying large refinancing needs. When consumption is growing, even if slowly, the picture is different for consumer staples, essential services, regulated utilities, telcos, and selected export-linked businesses. So, first investment lesson is this. Do not analyze this as one economy. Analyze it as two. One economy is still consuming and exporting, although more cautiously. The other is delaying or cutting investment. That difference decides who protects earnings and who disappoints. Now add the second problem, inflation. Headline inflation hit 7.2% in April, then eased to 6.2% by July. That direction is good, and no one should ignore an improving inflation trend. But 6.2% is still uncomfortable. It remains above the BSP's 2 to 4% range, and core inflation, if you strip out selected food and energy items, also remains elevated. What does that matter? Or why does that matter for equities? Well, because it narrows the BSP's room to ease rates. The peso has weakened toward record territory around 62 to a dollar in August. Oil prices have surged when a weaker currency meets expensive energy. An external shock becomes sticky domestic inflation. The BSP then faces a difficult trade-off. Ease too soon and it risks adding pressure to the peso and inflation expectations if you stay restrictive for longer, and it adds stress to borrowers, property markets, investment spending, and valuation multiples. So this is why rate cuts are not simply a switch. investors can assume will be turned on because growth has slowed. On August 27th, the BSP decision is the immediate test of that tension. So this is where the long-term chart becomes very important. The PSEi peaked at 9,058 points in January 2018 and it's never decisively recovered from that level. It bottomed at around 55.84 in 2025 and now it sits at 61.90 after the latest sell-off. So meanwhile, nominal GDP has more than doubled from the mid-2010s. That gap is not evidence that the market is broken, nor is it proof that the index must catch up. Markets are not a rubber band tied mechanically to GDP growth, but it does tell us that investors have spent years assigning a significant discount to Philippine equities. Why? Liquidity remains thin compared to global alternatives. Foreign capital has often left faster than it returned. Governance and policy uncertainty carry a cost, and the index itself is not perfect representation of the most dynamic parts of the economy. And of course, earnings expectations have repeatedly proved too optimistic. So why then, when someone says the market is cheap, what do you say? The appropriate response for me is cheap relative to what and why? A property developer with leverage and refinancing risk can look cheap. A regulated utility with contracted cash flows can also look cheap. And those two are not remotely the same risk and not remotely the same investment. Cheapness is a starting point for analysis. It's not the conclusion. Here is the distinction I want you to remember. Cheapness is not a catalyst. A market can stay cheap for several more quarters. It can remain cheap through earnings downgrades, weak foreign flows, policy uncertainty, and high interest rates. But cheapness can also provide something more valuable, a margin of safety. Margin of safety is not a promise that an investment will not fall. It's the gap between a valuation that requires perfection and one that can absorb imperfect reality. The PSEi is clearly not priced for a fairy tale recovery. It spent more than a decade disappointing investors. That means the risk reward setup for patient capital is becoming more and more interesting. But, and this is important, it does not mean tactical investors should pretend the macro deterioration does not exist. A decade of frustration may be priced in, a full earnings recession may be not priced in. So underweight does not mean zero exposure. It leads to a point that is often misunderstood. When I say I am underweight Philippine risk assets, I do not mean zero exposure. Underweight is a relative portfolio decision. It means the broad market does not currently deserve a full aggressive allocation given the balance of growth, inflation, currency earnings, and foreign flow risks. It does not mean every Philippine company is unattractive either. And it does not mean a long-term investor should wait in cash for a perfect entry point that may never arrive. So for investors with multi-year investment horizons, low expectations, and depressed valuations can create a much more forgiving starting point. The practical approach is two-track. Tactically, remain underweight broad beta while the macro evidence is still deteriorating. Strategically, build selective exposure to companies where the balance sheet, the cash flows, valuation, and dividend capacity will carry you through this turbulent adjustment. In other words, underweight, not out. Selective, not scared. Ready, not reckless. Here's how I score the market today using my great market and macro signal framework. So G for growth. Score is 0. GDP growth has slowed sharply and the weakness is concentrated in investment and industry. R for rates and inflation, 0. Inflation is moving in the right direction from the April peak, but it's still too high. The peso is weak and the BSP has limited freedom to ease rates. E is for earnings and valuation. Score is 1. Valuations are cheap enough to provide some margin of safety, especially for companies with credible earnings and cash flows. Is for adverse risks. My score is 0. Slower investment, sticky inflation, currency pressure, refinancing risk, and potential earnings cuts remain real. T is for trends in foreign flows. So this one's more nuanced. Recent buying has broadened beyond a single heavyweight into names such as BPI, Jollibee, and Meralco. That's constructive. However, year to date, foreign flows remain net selling by roughly 9 billion pesos. And in late August, turnover has been below 5 billion pesos, and the most recent week has not confirmed the clean broad reversal. So the honest score is not 2 out of 5, it's actually 1 out of 5. That's not a prediction of disaster. It's a signal that today, macro and flow conditions do not justify overweight broad Philippine risk assets. What do you mean when the macro, what do you own when the macro is ugly? Well, not every cheap stock. You want companies that can withstand being wrong. On the macro, I would focus on 5 traits. First, pricing power. Can a business pass higher costs through to consumers or customers without destroying demand? Second, durable cash flows. Recurring, contracted, regulated, or necessity-led revenue matters more when the growth is weak. Third, conservative balance sheet. So look for modest leverage, manageable refinancing schedules, and strong interest coverage for the companies. Number 4, dividend credibility. A high yield is not useful if it's funded by fresh debt or unsupported by free cash flows. Fifth, earnings visibility. The best companies in this kind of market do not require sudden discretionary spending to boom or a rapid capex rebound to meet expectations. That leads me to a bias on the sectors. I would lean more favorably toward consumer staples, regulated utilities, telcos, and select export-linked services. I would be more cautious on businesses waiting for a capex cycle to restart. Highly leveraged property developers, construction and industrial capex plays. This is not about owning defensives blindly. It's about owning business models that remain investable even if the economy stays awkward for a longer period than what the consensus expects. So what would make me more constructive? I would want to see inflation fall convincingly without renewed peso stress. I would want BSP to have genuine room to ease. I would want investment to stabilize, not just consumption to hold up. I would want earnings estimates to stop falling, and I would want foreign buying to become sustained, broad, and supported by better value turnover or liquidity. What would make me more defensive? Well, further growth weakness, more peso pressure, inflation that stays high for longer, a BSP forced to remain restrictive, or a fresh round of earnings downgrades. Markets can handle bad news. What they struggle with is bad news that keeps getting worse than expected. So here's the payoff. The PSEi may be cheap for the wrong reason, but it also may be cheap enough that the right businesses are beginning to offer a genuine long-term margin of safety. So that's the difference between being bearish and being selective. The market doesn't need a fairy tale to work from here. It needs inflation to keep easing, investment to stop collapsing, and corporate earnings to prove more resilient than what investors fear. Until then, my stance is clear. Underweight broad Philippine risk assets, overweight quality, cash flow, pricing power, and balance sheet strength. Now, for patient capital, don't confuse underweight with zero exposure. Be underweight, but not out. Be selective, not scared. Be ready, not reckless. So if this framework works for you, more Philippine analysis, more company research, and for the next installment of Value versus Trap, subscribe to this channel. This is June on investing. Stay integrated, stay curious, and stay ahead. I'll see you in the next one.